Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and we begin with the updates for the day. Folks, the EM or the emerging markets have survived the aggressive rate hike regimes, but now the EM currencies seems to be yielding. Chinese Yuan weakened further, and even Korean Won or any other Asian currency, if you will see, have yielded, except for IDR, which has shown some sort of strength on the YTD basis. Even with respect to China's growth, we have seen Nomura downgrading full year's growth forecast, while Russia has already reported a shrinking economy in the first quarter. Australia released a weaker than expected employment number, and with all these glooms on the global market front, there is still some sort of semblance, as there was a lot of hopes on the credit on the debt ceiling negotiations from the U.S. administration. On the domestic front, the FIA continue to pour in money, and even the CAD forecast or the current account deficit forecasts are coming lower. So, JK, what are your thoughts on these kind of updates?
Good morning, Shikhar. Yes, there is some pressure on the EM currencies that was seen in the last few days as the dollar strengthened with uncertainty on the debt ceiling talks ruling the market sentiment. Also, the U.S. data and yields on the higher side pressured the dollar upside, and EM markets generally were under pressure. Uh, Particularly on the Asian side, where Chinese Yuan crossed the psychological mark of 7-8, even now trades above that level. Uh, However, yesterday we did see some relief for the EMs in the US session after there was you know positive indications from the Speaker of the House of Representatives, Mr. McCarthy, and also the President Biden, who were actually, saying that the resolution to the debt ceiling were almost, quite doable by Sunday. And in fact, there was a statement saying that common ground will be found in the next week or so. That was published, and also leaders did agree that there will not be any default at all. So these are comforting statements with the markets latched onto, and based on this, we did see a lot of improvement in the sentiment. These statements along with the recovery in banking shares, making share index recording one of the largest one-day rises of 6.8% since June 21, led to US indices rising more than 1.2%. The data on housing starts also climbed 2.2% with an annual, to an annual rate of which was more than 1.4, with an annual rate of 1.4 million units, as against the forecast of a decline. March had in fact seen a big fall too. However, it's too early to conclude recovery in the sector, as the market rates are still quite high. However, the market was in a mood to latch on to any positive news, along with the positive statements from authorities over the debt ceiling talks. So it was a quite a bias on the upside for the markets. And in fact, the strong GDP and consumption data from Japan also added to the positive sentiment. There was a strong reversal in the European session, of course, which had the shares trading weak, but that reversed in the US session. A rebound in oil prices after a better demand forecast from IEA and expected purchases from US government to replenish the strategic petroleum reserves also helped, the crude prices and the oil related shares. So we did have a very good session in the stock market, and that has actually had a positive impact on the Asian markets as well. On the yields, near-term T-bill yields, which are the biggest risk in the event of a debt default, saw their yields ease a bit after the positive voices from McCarthy and Biden. 2-year yields, of course, rose 9 BPs on the day, with the risk-on sentiment leading to bond sell-off. And now we are up almost 5% on the 2-year yield in the last 2 weeks, despite the market's presumption of Fed pause in June and rate cuts later in the year. I believe the market is definitely excessively positioned on the long side of US Treasury, expecting rate cuts. And as more and more Fed speakers are unrelenting and nullifying pause expectations and also expressing concern about stubborn core inflation, stop selling may be adding to the upward pressure on the yields. Pressure is also building on long-term yields as huge supplies of paper are seen from the corporate, and this will only increase if and when a deal on debt ceiling is arrived at, because there will be a deluge of issuances from the Fed, which has been on the hold for some time now, apart from in the issuances against those which are maturing. Now, strong data from Japan has also reignited the debate whether the Japanese authorities are justified in sticking to their ultra easy monetary policy, particularly when inflation is also going at multi-year highs. Normal analysis does not seem to hold water here as far as the Japanese policy approach is concerned. And you were talking about the EM markets under stress, because a lot of it can be pinned down to the fact that the global trade seems to be on the decline. In a general way, we did have a big drop in import and export from China. Last week we did, early this week we had a big drop in Indian imports and exports also. And today another sign of it was seen when Japanese trade figures for April was announced. Exports rose 2.6% versus 4.3% previous, and imports fell actually 2.3% versus a rise of 7.3% last month. So although Japanese trade balance improved, this is again seen as a sign of demand slowing down, and this should be, one of the reasons why most of the EMs are also under pressure, because most of them are dependent upon the global trade or global exports. In another sign of economic slowdown, Australian April employment also unemployment also rose, and the jobless rate was up by 0.2%. The employment unexpectedly dipped following 2 months of outsized gains, which is seen as the Australian Central Bank in a fix as well as the rate hikes are concerned. On the USD, major currencies were lower against the dollar yesterday, continuing the trend that started early last week, and dollar index itself was trading almost above 103, and we do have good resistance at 103.40 on the dollar index, which should be holding for some time, but a lot will depend upon now on the economic data from other regions like UK and Europe, because we do have a situation where US economic data is not as bad as had been expected, while we are seeing poor numbers, particularly from the European side. And so this is a situation where we should see dollar probably post some more gains on a correction basis. Of course, we did have an improvement in the commodity currencies overnight because of the improved sentiment after the debt ceiling talks were seen to be positive. As for the rupee, it has continued its gradual weakness, which began with the move on central banks' steadfast intervention at lower levels, and the market now seems to be latching on to it. Breakout above 82.25 has led marketplace to shift their bias to more upside, and it is also accompanied by weakness in other Asian currencies led by Chinese Yuan. Strong recovery in the dollar, rise in US yields, and risk aversion on the debt ceiling all have contributed to USD INR moving towards the key 82.50 resistance. Of course, from medium-term perspective, there have been some good news. Government announcing higher incentives for PLI scheme in the hardware sector with a total outlay of 17,000 crores. And there are news reports saying that Tesla has proposed setting up a factory in India for domestic sale and export. So from a near-term perspective, rupee will definitely be following other Asian currencies. And today we do expect a narrower range of 80 to 30 and 80 to 45. Thank you.
Okay, JK, that was quite good. And yes, folks, the EM currencies saw some relief after the comforting statements on the debt ceiling negotiation. But what we also saw was some sort of recovery in the banking shares, while the near term T bill yields also recovered a bit after a good session of inversion being created in the shorter and the longer term tenors. Apart from that, what we have also observed, and JK has mentioned in his commentary, the strong numbers on the Japanese economy have now started raising questions on the need for the ultra easy policy, which was earlier being posed when the inflation was quite high. So now it's in either of the situations that the market participants are raising questions on the need for the ultra easy policy that the Japanese economy has been having. But all said and done, they have had a good number on the trade balance side. But what's also again interesting is the declining global trade and the reducing import numbers across. On the domestic front, higher incentive on the PLI schemes in the hardware industry, as JK mentioned, can be seen as a good positive, while there has been good developments on the Indian market as well. And as mentioned earlier, foreigners have been coming in with money pouring into various markets in the Indian industry. So that's pretty good to see the flows coming back in to the nation. But we'll end the session today over here and come back again tomorrow with another round of updates. Thank you so much for listening.